Imagine a number that follows you around. It's not your age or your phone number. This number tells a story about your financial habits. It quietly influences some of the biggest decisions in your life, from the car you drive to the apartment you rent. This number is your credit score. Many people feel intimidated by it, or worse, they ignore it completely. But ignoring your credit score is like driving without a speedometer. You might be going way too fast or dangerously slow, and you won't know until something goes wrong. Understanding this number is the first step toward taking control of your financial future and unlocking opportunities you might not even know exist. So, what exactly is this powerful number? Think of it as your financial report card. It's a 3-digit score, typically ranging from 300 to 850, that summarizes your history of borrowing and repaying money. Lenders like banks and credit card companies use this score to quickly gauge how risky it would be to lend you money. A higher score suggests you are a reliable borrower who pays bills on time. A lower score might signal to them that you've had some trouble in the past. It's a snapshot of your creditworthiness at a specific moment, calculated using information from your credit report. It's not a judgment of your character, just a reflection of your financial behaviors. Why should you care? Because your credit score matters more than you think, and not just for big-ticket items like a mortgage. Landlords often check your credit before handing you the keys to a new apartment. Some employers review credit histories as part of their background checks, especially for jobs involving finance or security. Even cell phone providers and insurance companies might look at your credit information to decide what rates to offer you. In our modern economy, a good credit score is like a key that can unlock better deals, lower interest rates, and more financial flexibility, saving you a significant amount of money over your lifetime. Grasping this concept is the foundation of building a strong financial life. It's not about being perfect with money or never making a mistake. It's about understanding the rules of the game so you can play it to your advantage. Let's make this real with a story about two friends, Maya and Liam. Both are in their late 20s, have similar jobs, and earn about the same income. They both decide it's time to buy their first car and head to the same dealership to get a loan for $20,000. This is where their financial stories take a sharp turn. Maya has always been diligent about her finances. She pays her credit card bill in full each month and never misses a student loan payment. As a result, she has an excellent credit score of 780. Her financial habits have paid off in a big way, proving to lenders that she is a very low-risk borrower who can be trusted. Liam, on the other hand, has been a bit more forgetful. He's paid his rent late a few times, missed a couple of credit card payments, and often carries a high balance on his card. He didn't think these small slip-ups were a big deal, but they added up. His credit score is 620, which is considered fair or subprime. When the loan officer pulls their credit reports, the difference becomes crystal clear. The bank sees Maya as a sure bet. They see Liam as a bigger risk. This perception, based entirely on their credit scores, will have a direct and immediate impact on their monthly budgets and the total cost of their cars. The dealership offers Maya the car loan with a fantastic interest rate of 4%. Her monthly payment comes out to about $368. Over the 5-year loan term, she will pay a total of roughly $2,080 in interest. She's thrilled. Liam gets a very different offer. Because of his lower credit score, the bank considers him a higher risk for defaulting on the loan. They approve his loan, but at a much higher interest rate of 11%. His monthly payment will be around $435, which is $67 more than Maya's every single month. This might not sound like a fortune, but it adds up quickly over time. Over the life of the loan, Liam will pay a staggering $6,100 in interest. That's nearly $4,000 more than Maya for the exact same car, all because of that 3-digit number. This extra money isn't going toward the car. It's going straight to the bank as a fee for the risk they took on him. So where does this magical number come from? It isn't pulled out of thin air. It's calculated using a complex algorithm that analyzes the information in your credit report. The two most common and influential scoring models are the FICO score and the Vantage score. While their formulas differ slightly, they both focus on the same core aspects of your financial behavior. FICO is the older and more widely used model. so understanding its components gives you a great roadmap for building good credit. Think of it like a final exam grade that's broken down into different weighted categories. Some parts of the test are worth more points than others. The most important factor, making up 35% of your FICO score, is your payment history. This is the big one. It simply answers the question, do you pay your bills on time? A long history of on-time payments will boost your score significantly. Conversely, late payments, accounts sent to collections, and bankruptcies will drag it down fast. Even one payment that is 30 days late can cause a noticeable drop. This is the heavyweight champion of credit score factors because it's the most direct indicator of your future reliability. Lenders want to see a consistent and dependable track record of you meeting your obligations. The second biggest piece of the pie, at 30%, is amounts owed, often called your credit utilization ratio. This primarily looks at how much of your available credit you are using, especially on revolving accounts like credit cards. If you have a credit card with a $10,000 limit and you have a $5,000 balance, your utilization is 50%. Experts recommend keeping this ratio below 30% and ideally below 10% for the best impact on your score. High utilization signals to lenders that you might be overextended and relying too heavily on debt, which makes you seem like a riskier borrower, even if you never miss a payment. The remaining three factors carry less weight but are still important. Length of credit history accounts for 15% of your score. This considers the age of your oldest account, your newest account, and the average age of all your accounts. A longer history generally helps your score, which is why it's often wise to keep old, unused credit cards open. New credit makes up 10%. This looks at how many new accounts you've recently opened and how many hard inquiries are on your report. Opening too many accounts in a short period can be a red flag. Finally, credit mix, also at 10%, considers the variety of credit you have, such as credit cards, retail accounts, installment loans like a car loan or mortgage, and finance company accounts. Lenders like to see that you can responsibly manage different types of credit. Understanding the factors is crucial, but it's also helpful to know how the final numbers are graded. Just like in school, where an A is better than a C, a higher credit score is better than a lower one. Lenders use these score ranges to sort borrowers into different risk categories, which then determines whether you get a loan and what interest rate you'll pay. While the exact ranges can vary slightly between lenders and scoring models, they generally follow a standard scale. This scale helps you quickly understand where you stand and what you need to aim for to get the best financial products and terms. Let's break down the typical FICO score ranges, which span from 300 to 850. A score between 800 and 850 is considered exceptional. People in this range are seen as top-tier borrowers and will have access to the very best interest rates and loan products available. A score from 740 to 799 is considered very good. You'll still qualify for excellent rates and have a high chance of approval for most types of credit. These two top tiers are where you want to be, as they offer the most financial power and flexibility, saving you thousands over time on loans. Moving down the scale, a score in the 670 to 739 range is categorized as good. This is the average range for many Americans, and it generally means you are a responsible borrower. You will likely be approved for most loans, though you might not be offered the absolute lowest interest rates available to those with very good or exceptional scores. Below this, a score from 580 to 669 is considered fair. Lenders see borrowers in this category as subprime, meaning there's a higher risk of default. You may have difficulty getting approved for traditional loans, and any credit you do get will likely come with much higher interest rates and fees. Finally, any score below 580 is considered poor. It can be very challenging to get approved for new credit with a score in this range. You may have to turn to secured credit cards or credit builder loans to start rebuilding your financial history. A poor score has significant real-life consequences beyond just loans. It can make it harder to rent an apartment, as many landlords see it as a sign of unreliability. It can even lead to higher car insurance premiums, or require you to pay a security deposit for utilities or a new cell phone plan. Your score is a direct reflection of your perceived risk, impacting far more than you might imagine. Now that you know how important your credit score is, you're probably wondering, where can I find mine? The good news is that it's easier than ever to check your score, and you can often do it for free without hurting it. Many credit card companies, banks, and loan providers now offer free access to your credit score as a customer perk. Simply log into your online account portal or mobile app and look for a section often labeled Credit Score, FICO Score, or Financial Wellness. This is a great, no-cost way to keep tabs on your score regularly. If your bank doesn't offer this, there are several reputable websites that provide free credit scores, such as Credit Karma, Credit Sesame, or Wallet Hub. These services typically provide a Vantage score, which might be slightly different from the FICO score a lender uses, but it's still a great barometer of your overall credit health. They make money by recommending credit cards and loans to you, but you are under no obligation to apply for anything. These sites also offer helpful tools like credit monitoring, which can alert you to important changes on your credit report, helping you spot potential fraud early. It's crucial to understand the difference between a credit score and a credit report. Your credit score is the 3-digit number, the grade. Your credit report is the detailed transcript that provides all the evidence for that grade. It's a comprehensive record of your credit history, including a list of all your credit accounts, your payment history for each one, your outstanding balances, and any public records like bankruptcies or collections. The 3 major credit bureaus, Equifax, Experian, and TransUnion, each maintain a credit report on you. Your score is generated from the information in these reports. By law, you are entitled to a free copy of your credit report from each of the 3 bureaus once every year. The official, government-authorized website to get them is annualcreditreport.com. It's a smart habit to pull all 3 of your reports annually to review them for accuracy. Errors can and do happen, and a mistake on your report could be unfairly dragging down your score. If you find an error, such as an account that isn't yours or a payment incorrectly marked as late, you have the right to dispute it with the credit bureau to have it corrected. Regularly checking both your score and your report is a fundamental part of managing your financial health. If your credit score isn't where you want it to be, don't panic. A credit score is not permanent. It's a dynamic number that you can actively improve over time. The key is to develop consistent, positive financial habits. The single most important action you can take is to pay every single one of your bills on time. This includes credit cards, student loans, car loans, and even rent if your landlord reports it. Since payment history is the biggest factor in your score, this is non-negotiable. Set up automatic payments or calendar reminders for your due dates to ensure you never miss one. A long track record of on-time payments is the bedrock of a great credit score. Next, focus on your credit utilization ratio. That's the percentage of available credit you're using. Aim to keep your balances low, especially on credit cards. A good rule of thumb is to keep your utilization below 30% on each card and across all your cards combined. For example, if you have one credit card with a $5,000 limit, try to keep the balance under $1,500. If you have high balances, create a plan to pay them down as quickly as possible. Making more than the minimum payment each month is a powerful way to reduce your debt and lower your utilization, which can give your score a relatively quick boost. Another strategic move is to protect the length of your credit history. This factor rewards you for being a long-term, stable borrower. For this reason, think twice before closing old credit card accounts, even if you don't use them anymore. As long as the card doesn't have an annual fee, keeping it open helps increase the average age of your accounts and keeps your overall available credit higher, which helps your utilization ratio. You can keep the account active by making a small, planned purchase on it once or twice a year and paying it off immediately. This demonstrates that the account is still in good standing. Finally, be thoughtful about applying for new credit. While you need credit to build credit, opening several new accounts in a short period can temporarily lower your score. Each application typically results in a hard inquiry on your credit report, and too many of these can make you look desperate for credit. If you're planning to make a major purchase like a car or a home, avoid applying for new store credit cards or other loans in the months leading up to it. Build your credit strategically and patiently. Consistent, responsible behavior over time is the proven formula for achieving an excellent score. As you navigate the world of credit, you'll likely encounter a lot of advice, some good and some just plain wrong. Let's clear up a couple of the most common myths so they don't hold you back. The first major myth is that checking your own credit score will hurt it. This is false. When you check your own score through your bank, a free credit monitoring service, or by pulling your own credit report, it results in a soft inquiry. Soft inquiries are only visible to you and have zero impact on your credit score. Lenders can't see them. It's only when a lender checks your credit for a loan application that a hard inquiry occurs, which can cause a small, temporary dip in your score. So go ahead and check your score as often as you like. It's a healthy financial habit. Another persistent myth is that you need to carry a balance on your credit card from month to build credit. This is not only false, but it's also expensive. Lenders want to see that you use credit responsibly, not that you're constantly in debt and paying them interest. You can build an excellent credit history by using your credit card for purchases and paying the statement balance in full every single month before the due date. This shows you are using credit actively and paying your bills on time, the two most important behaviors. Carrying a balance does nothing extra for your score. It only costs you money in interest charges. Never pay interest just for the sake of your credit score. In the end, your credit score is far more than just a number. It's a reflection of your financial journey and a powerful tool that can either open doors or close them. By understanding what it is, how it's calculated, and the steps you can take to improve it, you are taking a massive step toward financial empowerment. It's about building a reputation for reliability that will pay dividends throughout your life, saving you thousands of dollars and reducing financial stress. Good credit gives you options, flexibility, and the power to make choices that are right for you, not just the ones you can get approved for. You are in the driver's seat. Your journey to financial mastery doesn't end here. Now that you've demystified the credit score, the next logical step is to dive deeper into the document that provides all its data, your credit report. Understanding how to read your full credit report, line by line, is the key to spotting errors, identifying areas for improvement, and protecting yourself from identity theft. Stay tuned as we explore how to become an expert at reading your own financial story, ensuring that it's telling the tale you want it to.